4, 3, 2, 1. Buckle your seatbelt. Batten down the hatches. Coming to you live from the Blazar Podcast Studios in Space City, Texas. It's time once again for the Capital Catalyst Show, the podcast for entrepreneurs to learn the secrets of attracting, raising, and closing capital from high net worth investors. Dedicated to your success, this is the Capital Catalyst Show. Now here's your host, Brad Blazar.
Hey, welcome back, listeners. Once again, it's Brad Blazar here, the host of the Capital Catalyst Show, where we interview individuals that have successfully gone out into the world and mastered the art of OPM, playing the OPM game. Like Robert Kiyosaki says, mastering the OPM game is the key to building legacy wealth. My guest today has done exactly that. We connected a couple of years ago through an event. I have followed him, and he's done a phenomenal job, not only of building community and hosting a mastermind, but more importantly, changing the lives of the people he touches in the process. And so my guest today is the wonderful, amazing, and the exceptional Brad Sumrok. Brad, welcome to the Capital Catalyst Show.
Hey, Brad. I'm glad to be here. This is really easy because we got two Brads today.
Exactly. And it's funny, I joke, but when I was on Dropping Bombs with Brad Lee, it was the same thing, Brad and Brad. So
yeah.
Makes it real easy for us. But what I would love to start with today, in terms of sharing your story with our listeners, is how you got into the multifamily space, because you're largely known as one of the preeminent educators, obviously in that lane. But I'm sure there's a great story behind how you moved into that, and I'd love for you to share that story with our listeners today.
Yeah. Yeah. Thanks. Hey, I did everything right. I went to school, studied hard, got good grades, went to college. Neither of my parents finished their degree. So it was impressed upon me that that was the blueprint to have a good life. Yeah. And so I did all that. I got a degree, got a job, a pretty good job, grew up in Pittsburgh, and wanted to move up. So I went back and got another degree. My first degree was an engineer. The second was an MBA. But then I was making six figures. And there was a point in my life, Brad, that I just thought once I made six figures, I'd be set, did you ever have that kind of number? Like once you hit a certain number, because that was so far away from what, my family, anyone in my family had ever achieved. And so I achieved it, before I was 30, was making six figures. But then over the next few years, I got fired once. I actually got fired. I got laid off. We got acquired. I lost my job. And I found myself in my early 30s, hey, I did everything right. But this is not a secure way to make a living. And I'm not making the money. I don't have the freedom. I have 3 weeks vacation. So I picked up the Rich Dad, Poor Dad book that came out. And all these light bulbs went off, and then the second book with ESBI, the cash flow quadrant, I was like, okay, man, no one ever taught me this stuff. So that's when I went to my first real estate seminar. And I mean, otherwise you'd have never caught me in a seminar. I was highly educated. When I went into that seminar, I was so skeptical. I'm like, I know they're going to try to sell me something. But here's the deal. Somehow everything the guy was saying, mostly everything the guy was saying made a lot of sense. And so I turned from skeptical to, hey, this might work. Yeah. And I actually bought their program. So that's how one of the reasons I started my own educational platform, Brad, is because, I know there's a lot of skepticism out there, but if it wasn't for people like us that actually teach, the guy that taught me the business, changed my life, back at that point.
Right.
And so, I went from a skeptical person with 2 degrees to going out there and taking massive action. And the first investment property I ever bought was not a 2-plex, a 4-plex. I didn't house hack. I had worked for 14 years in corporate America, and I saved my money. I was doing everything right, living below my means, saving my money. And so I bought 32 units with my own money, put 20% down. Seriously. Wow. I put 20% down, got an 80% loan. That was back in 2002. And you know what the interest rates were back then?
I can imagine.
Well, it was 6.4%. You know what they are now? About 6.4%. And everybody thinks they're so high. but
Right.
over the long term, they're not really that high at all.
Yeah. Yeah. You talk about biting off more than you can chew. 32 units for your very first investment. I always tell people, man, learn the business, start with 8, 10, or 12, and then grow to 20, and then eventually, move up to 40 to 60. You just jumped right in, which I absolutely love. Just out of curiosity, I want to ask, do you remember who the educator was on that very first event?
Yeah, of course. Like, yeah. I mean, it's well, but I want to talk about the 32. See, I have students now that go right into large syndications, and my belief is like with the right team, the right community, the right mentor, like, I didn't do it by myself. I mean, honestly, I think it would be like business suicide to go out and try to buy a 30 unit, or even now like raise other people's money and buy 60, 80, 100 units with doing that on your own. And some people do that. But yeah, like the guy that taught me was a company out of Houston called Lifestyles Unlimited, and they're still there. And the funny thing was, when I retired, I retired from my 6-figure job within 3 years, and basically playing Robert Kiyosaki cash flow game in real life. And then they hired me. And so my first role as a real estate mentor was with them.
Gotcha.
And then I started doing their seminars. The same one I went to where I was skeptical, I started teaching their seminars. And then in 2012, I left. In 2013, started my own platform.
Love it. I love it. What a great story. It's funny because I got started with Russ Whitney, went to one of his events, and of course, bought the program, started investing, got a portfolio of about 13 properties, started exiting those, started rolling the proceeds into bigger and bigger deals. And, as they say, of course, the rest is history. But you get to a point where you realize that actually, I believe, maybe you concur, that doing bigger deals is actually almost easier than doing smaller deals, just bigger numbers. But, you realize that, like you said, it's a team sport. Property management companies, of course, will manage the property for you. And really what we become is more asset managers. You did your first deal, 32 units. That was great. Tell me when you decided to ultimately bring investors in alongside you. What did that look like?
Yeah. And just to your comment, like what I learned along the way, and I'll share that. So first deal was 32. Second one was 30. And the 30 was literally across the block, like catty corner. You could walk from property A to B. And so I went from 32 units with no professional management. I have a part-time helper at the property, part-time manager, part-time maintenance person, 62 units really close by. Now I hire a professional manager, a professional maintenance person. Life got 5 times easier. but I'm still doing the role of the property management company, and I'm paying the bills and doing the QuickBooks. The third deal was 250 units. And a broker brought me the deal, and I had no money because all my money went into those 62 units. Because that's what I learned at that organization where I learned from was, we weren't back then, with maybe very few exceptions, but there weren't that many people syndicating deals and raising money from other people. It was like buy your own properties with your own money. And then this broker brings me a 250 unit, and I had very little money left. But now I'm in the industry. I know people. I'm with that organization. I'm going to other, investment clubs. I'm building my own network. And I wasn't really doing it intentionally to build a network to raise money. I just, I had quit my job in 2005. I started in 2002, and now I'm like just making this my thing. And so I'm everywhere, I mean, that's where we met. We met at a real estate conference. So I'm everywhere now. And so when they brought me the 250 unit deal, it occurred to me that hey, I could go ahead and do this. And so I had already met a real estate syndication attorney that I knew, and I was ready. And so I'll never forget, I raised $2 million from 27 people and bought a 250 unit deal with very little of my own money.
Wow. I'm sure for you, that was a huge revelation, like a major aha moment, and in my life, there's been major aha moments as well in capital raising. I remember because I started my capital raising not in real estate, but it was actually when I was in my 20s. You know, here I am going to school, my background very similar to yours, had parents that always, you know, inspired us to go get a college degree, then go out, get a good job, then save, you know, and hopefully retire. And, you know, much like you, six figures. But when I was in college, I got a part-time job working for a small oil company. And my job was to get on the telephones, reach out to high net worth individuals and raise capital. And I was only working about 12 to 15 hours a week, going into the office between classes after school. And I was making six figures as a 21-year-old, working 12-hour weeks. So
Wow.
unbeknownst to my parents, I made the decision, I'm just going to quit showing up. And so I went into the office now working a full 40-hour week, really, you know, putting forth the effort, and saved up a couple $1,000. And at the age of 23, never having drilled an oil well, started an oil company. And, you know, built a team around me, got a geologist, got a landman, got the right team, started raising money. And here I am, you know, in my early 20s, raising millions of dollars from investors. And then, of course, in the late 80s, 90s, two major events happened. One was the Tax Reform Act of 87 that took away all of the incentives, and the other was just collapsing energy prices. That's when I went back to school. But then when I came out, I became a professional capital raiser and also got into real estate. But you and I both know, because we've been doing this so very long, that the landscape has changed dramatically. Like when you probably started raising money, they didn't have the Jobs Act. We couldn't solicit. We couldn't be doing funnels and social media and all the things that a lot of the capital raisers take advantage nowadays. So what processes did you use back when you raised that 2.5 million from 27 investors? Because, you know, you couldn't use social media back then. We can now. So how did you build that network initially?
Well, you know, and to this day, like I just did a 3-day workshop and I had 2 syndication attorneys at my event.
Yeah.
Like, and what I heard just this weekend is like 96 or 97% of just about every syndication falls under Regulation D 506B,
Yeah.
which is, you know, commonly referred to as like a friends and family fund, but it's way beyond that. It's you can't advertise, but you can offer it to people that you have a substantive pre-existing relationship with. So over time, when you go to networking events, you know, an exchange, you know, I'm not an attorney, so I'm not going to cover the rules, but you know, there's certain things that constitute like what is a pre-existing substantive relationship. And I can tell you what it's not, and it's not just picking up somebody's business card.
Right.
So, you know, there's a lot of people out there today, they go to these networking events and they come home with 200 cards, and then they're like blasting out their deal and trying to raise money. And it's like, my attorneys tell me that's not to do that. And so you need to get to know people, you know, and I'll leave it to the syndication lawyers to define what a pre-existing substantive, you know, relationship is. But, you know, in my book, it's getting to know, like, and trust people, and they get to know, like, and trust you, or maybe not even the like part, but it's getting to know people.
Right.
And so over a period of time, when you get to know people and you know what their goals are and their level of education and net worth and income and sophistication and what their, you know, what their investment goals are. And so just by being part of a investor community, like, you know, when you say what systems, was that the question? It was like, it was the old fashioned system, Brad. It's like, I went to networking events, I talked to people, I would get to know people, and I expanded my network. And then any type of tracking system I had back then was basically on a spreadsheet.
Yep. I remember mine was a little 3x5 card box that I kept on my desk, and I would scroll through the box. And if somebody said, call me back next week, great. In the front of the box were numbers from 1 to 31. I would pick the date and just move it back 7 to 10 days. And of course, in the very back of the box were the months of the year. And well, you know, the guy might be interested in a couple months, so I'll put him back in June or July. And that became basically my very antiquated CRM system, you know, back in the early 90s, because we really didn't have the technology that we have today. But I'm glad you brought that up, because I always tell people as I educate them, you've got to understand, we are in the securities industry. You know, the how we test defines what an investment contract is, but you have to get to really know your investor, the KYC role. And that's, of course, what the SEC says is, you know, you really get to ask them, about their investment background and really get to know them before you make that offer. The other thing that I find, really interesting about people that have changed their life, built obviously a network or a database of investors and focused, whether it's on, multifamily as you largely have, or other sectors. We have a lot of people that are in self-storage or doing, more retail, is how you go about and actually how you play the game. You now have an educational platform. And so, in your educational platform, in your mastermind, are you more focused on multifamily, how you find deals, how you work with brokers, how you underwrite? Or do you also spend a considerable amount of time teaching people how to finance the deals and how to raise the capital? Or is it maybe a little bit of both?
Yeah, it's both. So like, so what I, and I'll take a step back here. Like what I do is my two main businesses are I invest in and own, membership interest in entities that own apartment buildings.
Right.
And I haven't really deviated from that. Like I don't do self-storage, industrial, retail, hotels, ground up. I buy existing multifamily buildings, generally now like 150 doors and up, generally C+ to B class. I have some A class as well. And I'm generally in Texas and Florida and other landlord and business friendly environments, Nashville, but most of my assets are in Texas.
Mm-hmm.
And, we make money doing that. Like, and we have the deals cash flow and over the long term go up in value, especially if we're hitting our projections and there's substantial tax savings. And then when those deals sell, I have a big capital gain and I try to reinvest as much of the gain as I can in the same year so I could offset that gain with the depreciation that I get on a new acquisition. Sure. So, that's one source of income.
Yep.
And every time I do one of those transactions, I'm usually on the GP side and I'm involved at some level in the capital raise.
Right.
And then I've been in the education business first with, the company that I went to and learned from. And then I started my own in 2013 and I got into the education business. I shared with you why. It was like if it wasn't for people in the education business, I would have never got in.
Right.
I would have never got in it. And so, thank goodness for guys like Robert Kiyosaki that write these books and other people that are out there teaching. And so the people that are out there teaching, it occurred to me that I had a gift as well to take something, that seems somewhat complicated, like buying an apartment complex and breaking it down into actionable, digestible steps. And so look, like part of my program is like, of course, it's like understanding the business model, understanding the numbers, like my whole, call it a framework. Step one is you got to understand it. You got to understand the business model, the projections, what a cap rate is, NOI, business model, raising the income, optimizing expenses, how to find the deals and where to find the deals, how to analyze the deals and what tools and information you need. Well, guess what? After you analyze it and you make the offer on it, you got to fund it. So then a big piece of my program is funding the deal. And there's the debt side, there's the debt piece and there's the equity piece.
Yeah.
And then on the equity side, it's like, so how do you raise the money? Where do you raise the money? I mean, so no, I don't have like a formal, specific dedicated program just on the capital raising, but it's a big piece of what I do.
Absolutely.
Because, like just this weekend, I used a $10 million deal in my workshop as an example. And to buy a $10 million apartment building, well, 2 years ago, you needed 2 million in debt. 2 million equity and 8 million in debt. Now you need 4 million in equity and 6 million in debt.
Yeah.
Because the loan amounts changed. The rates went up and lenders have tightened up.
Yep.
So I asked my, attendees at the event, if you found a $10 million today, would you be able to get 4 million of equity? And then the question comes down to like, well, what does that look like? And in my experience in the retail investing arena, unless you have like family offices or high net worth individuals, like an average investor might put in 50 or 100 grand. So to get to get $4 million, you need,
Yep.
you know, say 60 people that are going to say yes, but not everybody's going to say yes. So you need to
Yep.
put that deal in front of 200 or 300 people.
Right. Right.
So that, and I start teaching that because I want people to know, like, you need to be in rooms and you need to learn the skills and the strategies and implement the systems and the processes.
Mhm.
That you could go out and just to do one deal, and we're not even talking about a fund, which I know is your model, but just to
Yep.
do one $10 million deal, you need to be able to put it in front of 200 people.
Right. Absolutely. No, totally. And of course, the follow-up, the onboarding and everything else that goes right along with that, you know, on the back end of the deal. Of course, what a lot of people overlook is the reporting, the transparency. I tell people, look, you know, the capital raising is where it begins. But once you take the person's money, you close on the asset. Now there's a whole nother set of things that have to take place, which is, you know, quarterly newsletters, you know, at the end of the year, the tax reporting that goes out. You know, how does that work? Because a lot of people just think, oh, I'm just going to raise the money, go out and buy the deal. And I'm like, no, you're not. Because if you do that, you're going to get a lot of people calling you after 6-9 months wondering what the hell's going on. Why am I not hearing from you? You know, and so there's the whole back end engine as well, which I tell my students, you got to also think about what the back end of this looks like, which is building the trust, building the relationship so that those investors feel comfortable opening up their network to you because they see you tangibly delivering on the things you told them that you were going to do as a prudent and as a good operator. And hopefully over time, capital raising becomes easier because now you're getting referrals. People are opening up their network to you. You're doing the right thing.
Yes.
Yep.
Yeah. And in multifamily, what I do, like my model is to buy 60 units and up. I mean, I don't buy anything now under, you know, say 100, 120 and prefer 200. But even with 60 units and up, like you're going to likely have a professional, you know, third party property management company. And so the reporting becomes, and you, I think you alluded to this earlier, you know, and I forgot to complete that thought too. It becomes easier when you have 200 units versus 32 or 62. And why is it easier is because the 200 unit gives you the scale out of your cash flow to hire a professional management company.
Right.
And that professional management company not only provides the site manager, the leasing agent, the HVAC certified maintenance team, you know, the make ready, the housekeeper. So they provide and train all those people and they understand all the fair housing and all that type of stuff. So you're actually by buying into a bigger building with other people's money, you're actually able to afford professional management. Most people think they're better property managers, but they're not. The professionals are better property managers.
Yeah.
And and the other thing they do in multifamily, I'm sure they do it with other asset classes as well, is they prepare a monthly report where you have all the information to send out to the investors each and every month. You know, the rent rolls, the balance sheets, the P&L, the delinquency reports, how the property is doing. And then on the GP team, we could usually log into the property management software, you know, just about any time we want, and we could go into a dashboard. My management company send me, like, you know, in these workflow things like Monday or Slack or whatever, and they'll update things every week with like KPIs and stuff like that, so that we could, you know, keep track of things.
Sure. Yep. Absolutely. And we do the same thing as well. You know, we have not only the property management team, we have an asset management team as well. And, you know, you're absolutely right. They take care of pretty much of all the headaches. You know, you graduate from managing, as I like to say, tenants and toilets, to managing relationships with these professional companies that will do all of that work for you. One thing I always love to discuss with people that come onto the show, Brad, is, you know, maybe an obstacle or maybe a problem that you encountered early on, you know, as you were building your track record and as you were, you know, building your portfolio, because we all learn from our prior mistakes. Share a mistake maybe that you identify with, maybe that you made early on in your career, and, you know, what you learned from that, because I believe that as educators, what people are really largely paying us for is not only our knowledge, but it's also the mistakes we made along the way, so that hopefully they can avoid making those some mistakes. What would you say, you know, looking back at what you've done has been a mistake? And more importantly, what did you learn from that?
Well, that's a good question. And I'm sure if I thought about it overnight, I could probably come up with some things that are really profound, because I have made mistakes. But the first thing that jumped to me was like, we're kind of in a market downturn now. And, I've been through the 2008 financial crisis, and I just remember like really slowing down. Like I slowed down, and I went through, like, because I bought a few deals in 06 and 07. And then, in 08 and 09, I'm like, in a little bit of a pickle. And the good news is, by the way, I got through those deals. I got through those deals. And so I remember probably going through a 2 or 3 year period of time where I personally didn't buy or invest in anything. And I don't know anybody looking back that wishes they would have bought or invested in less real estate, like in 2009 or 2010.
Yeah.
And I'm not sure what you were doing back then, but it occurs to me that some people are doing that now. They got into some multifamily deals, when interest rates were 3.5%, and they got these variable rate loans, and some people were in challenging situations. And so what I'm seeing now is like, I feel like 80% of the market is like on hold. People are just on hold.
Yeah.
And I see the opportunity. Like, real estate is on sale. Deals are trading for 20 to 30% less. The competition out there for buyers is less. And I know, because I'm selling deals right now, and I'm not getting the offers that I want, and I'm not getting the pricing that I want, and I'm not getting the terms that I want.
Yeah.
So like, I'm telling people, like, I just did this 3-day event, and I'm like, you got to understand, and it's Warren Buffett's quote, not mine, but Warren says, something along the lines of like, when people are greedy, be fearful, and when people are fearful, be greedy.
Right.
So the first thing that occurred to me is like, there were just some periods of life where I slowed down because of what was going on out there. Okay. And that to me was a mistake. And then the other one that just hit me is that, in multifamily, I love being on the general partnership team because of the scale that that you're afforded as a GP, as opposed to trying to buy your own deals with your own money. You're extremely limited with your own financial resources, your own time. And there was a period of time, like in 2012, 2011, 2013, where I would basically do like 1 or 2 deals. If I could do 1 deal a year or 2 deals a year, it was like a big deal.
Yeah.
And that's because I was doing everything myself, meaning like I'd find the deals myself, I'd analyze them myself, I'd raise the capital myself, I'd secure the debt myself, then I'd turn into the asset manager myself, then I'd turn into the investor relationship manager myself, then I'm doing the CapEx overseeing myself. And all of this time, and during that period of time, I'm also launching my own education program. And I'm like, man, there's just not enough of me. And so one of the things I teach people was like the power of, and some people have gone to like insane extremes with this. Like, I never tell people to have 27 GPs in a deal.
Right.
And it occurred to me that some people were doing stuff like that, but like to have a really cohesive team of a handful of people that could share the profit splitting, the GP split between a few people, but also divide up the workload. So like, I love now partnering as a co-GP and finding, 2 to 4 other people, depending on the deal size, where we could divvy up all the work. And people could really specialize in what they're really good at. Some people love deal sourcing, some people love underwriting, some people are lending their balance sheet and liquidity to secure loans. Some people are focusing more on raising money along with other substantive duties. Some people are, really dialed into asset management or CapEx management. And so to find a group of people like that where you're all in alignment and working together is beautiful.
I agree 100%. And you brought up a really great point that I think a lot of people often overlook, especially, you know, in the real estate space, where we largely use the term co-GP loosely and invite people to come and be a part of our co-GP team to, you know, help in the capital raise. And of course, this is an area that I know most of the securities attorneys really focus on, because in that role, if all you're doing is just raising capital, you're really not qualifying under the true definition of a GP, relying on the issuer exemption. And so I always tell people, look, you know, if you're going to be working with somebody as a co-GP, you should have other responsibilities and other tasks in that role above and beyond just that of raising capital. So that, number one, you're not only learning the business, but you're also qualifying for what you're entitled to, because technically they can't pay you a commission. They can't pay you an amount that's tied to what you bring to the table if you actually bring capital. So in order to rely on the same exemption that the GP's relying on, where you're not licensed, you got to be taking on a little bit more responsibility. So that's really a really
absolutely. Yeah, like it occurs to me, and I don't, I hear out there that people are getting paid to raise capital, and I'm like, how are people doing that? And who's the syndication attorney advising them?
Absolutely.
But some people just don't know.
Well, yeah, exactly. That's it. They don't know what they don't know, and then of course it's too late when they finally end up getting in trouble because they find out the hard way. And so I always tell people, work with the general partner that understands this, that's going to delegate certain responsibilities to you, so that, number one, you become part of that team, but now you're also qualifying under that issuer exemption because you're taking on those additional responsibilities that the general partner really undertakes in order to basically, rely on that issuer's exemption. So yeah, that's a really important thing that we make sure that everybody we work with understands, because there's so many moving parts, in the syndication industry with Reg D 506B, C, and all the other moving parts that just, people need to really understand to do it the right way.
Yes.
One thing I do want to just kind of quickly touch upon as it relates to, you and your events, that people want to learn, the multifamily space and, follow you. When is your next event? When are you doing your next mastermind or your next event?
Well, so I do events a few times a year that are intended for people that are not currently like in my, 1-year program. So I have a mentoring program, I have a mastermind, and I do these events a few times a year. But the events that somebody that would want to be introduced to my teaching and my framework would be September 27th, 28th, and 29. And I just completed a 3-day event, April 28th, depending on when people are listening to this recording, right? And so the next 3-day that I'm going to do is at the end of September. It's in Dallas. And Brad, I could send you like a QR code or a URL or whatever. But if outside of that, if people just go to my website, bradsumrok.com, there's an events tab there, and it'll be up there by the time this is published.
Gotcha. There you go. That's what I was going to ask you next, is how people follow you and how people connect with you, because that's certainly something that we always like to share to, bring value to our guests. And I think you just shared it right there, is just follow you at bradsumrok.com.
Well, the other one is, Instagram.
Yep, sure.
LinkedIn. I guess I'm still on Facebook, if anybody still uses Facebook. Do you think, I wonder if Facebook is going to go the way of MySpace? It doesn't occur to me. I think Facebook is like it seems like over the last 2 years, at least to me, everything has moved over to the gram.
Yeah, I agree.
But so yeah, I'm on Facebook, Instagram, LinkedIn. And I also learned that I didn't know that I didn't realize this, but there's like some fake accounts that people have on my name that actually have more followers than me. And I'm like, whoa, what is that? And they're like pawning, some of my students are like, Brad, is this you? I didn't know you were in crypto. And they're like these fake accounts that are not mine, where I'm advertising crypto and digital stuff. And I'm like, I don't do any of that kind of stuff.
Yeah. I get the same thing all the time. And, I just kind of laugh and I chuckle because what that means is that we've reached a level of success that others want to emulate. When somebody else wants to be in my shoes, I take that as a sign that that's a pretty damn good thing. But, I tell people just look for that little blue check where Instagram has verified me. And, like you, I'm not promoting crypto. I'm not selling anything. I'm largely just wanting to meet people, build a relationship, get to know them. And if it turns out that we end up collaborating and doing business, great. If not, that's fine too. But yeah, it's funny that, as you're on social media and you're building a business, how these people kind of emulate you and create these pseudo names and kind of take on your persona and, start promoting all of this other crap. And I'm like, nope, I don't promote stuff on social media. Yes, I do have a platform, but I only promote that once we actually get to know you and understand that what we're talking about is suitable and that's going to actually get you from point A to point B and hopefully benefit you in a positive way. So great. Let's talk just quickly about the big event that we're both going to be at here next month. I know that you're going to be in Toronto. I'm going to be in Toronto. We're going to be there at the multifamily conference. Our good friend Seth Ferguson, and of course, he spoke at our event that we did back in Miami. But I'm looking forward to that. Anything you want to share about what you're going to be talking about, or for your community? I'm sure that you're going to have a lot of people there, much like myself, that you're bringing to Toronto alongside you. But let's just quickly talk about that.
Well, it's interesting. My both of my businesses, when I buy and invest in multifamily, I do it in the United States.
Mm-hmm. Yeah.
Now, on my education platform, of course, the majority of my mentees, which I refer to as students, are also US based, but they're not exclusively US based.
Yeah.
I have Canadians, I have, Mexicans, I have people in South America, Central America. I have some people in even Australia, Dubai, a few Europeans. And so last year was the first time I went to the Canadian Multifamily Conference. And I was curious if I would be booed off the stage. But I went in there and I said, hey, I am here to talk about investing in the USA, because I did my research, Brad, and I don't even invest in, unfriendly landlord states and environments in the US. I don't invest in California, Seattle, Boston, New York City, New Jersey. And then I did my research, and I have some Canadian friends that are doing real estate, and they're telling me it's so much worse. These places that I just rattled off in the US would be like nirvana in some aspects. and as compared to compared to Ontario.
Right.
And so I just went right at it. And I was like, unless you want to buy a property where somebody can live at your property for 14 months and not pay you legally, the government's going to give you a hard time about it. You might want to consider investing right here south of the border in the USA.
Right.
And I mean, I was a little nervous. I'm thinking am I going to have people throwing eggs and tomatoes at me? And it was the opposite. Yeah. It was you're speaking my language, Brad. Yeah. I'm so excited. I got off the stage. I was surrounded by hundreds of people. And so I'm going to do the same. I'm going to go up there and I'm going to talk about the opportunity for Canadians to invest right now in 2024 in multifamily buildings in the United States.
I think,
and they don't have to move here, although some are. That's another thing. It really, I didn't tell them to move here, but they're like, Brad, we heard you speak. We came to your training in Dallas. We signed up for your mastermind, and we're moving to the USA. And I'm like, oh my God, talk about changing people's lives. But I didn't, so if you're in Canada and you're listening to this, I'm not going to tell you to move to the United States.
Right.
And you can live in Canada and invest, whether you're a limited partner or a co-GP, as long as you can add value to a team. And, one of my buddies is Canadian, and he's down in Florida right now walking an apartment building.
Love that.
We're emailing each other right before I got on your show.
Yeah.
So and that's the other beauty, Brad, of buying, say you're in a 100 unit deal or 136 unit deal. you don't have to buy in your own backyard. See, if you buy 8 units, 4 units, 6 units, and you're
Right.
going to self-manage, well, you don't have economies of scale. So like you are the property manager. You need to go there.
Yeah.
But if you buy 136 units, you have a professional management company. Now you'll need to be working closely with them and have access to the investor portal and the property management software and all that, and KPIs and all those things I talked about like 30 minutes ago.
Sure.
But you don't need to be living in the same area, and you don't need to be going on site every day.
Mm-hmm. It's funny. I was on a call earlier today with one of our mentees that's in Vancouver. And he's like, we have our project right now that we're doing in California. He's actually developing 30 townhomes. And he's like, my wife and me are looking at, relocating to the United States. We're trying to decide Florida or Texas. I'm like, man, 2 great states. Like, that's a tough one. You might want to flip a coin. And I also like the Carolinas. I told him kind of that mid-Atlantic stretch as well. North and South Carolina, we really like. But it's right. People are moving to the United States for those opportunities. But you hit the nail on the head, because we currently have mentees in all of these other countries that you mentioned around the world: Australia, New Zealand, the Middle East, over in the Asian nations, Singapore, Hong Kong. But it seems like there definitely is this big interest in investing in the United States. There's great deals, there's great opportunities. And what I'm finding is I talk to my Canadian mentees, they live in Canada, but they're actually raising money from US investors. Their perception, I think, is that U investors tend to act a little faster. They're easier to commit and transact capital. And a lot of these guys that live up in Canada are just finding it really tough to raise money from Canadian investors. I don't know why, but that seems to be the perception, at least, that we're hearing about. I don't know if you're hearing something similar as well, where your Canadian mentees are targeting and raising capital from people here in the United States, or are they still raising capital from people back home in Canada and other countries?
I think they're doing both.
Yeah. Okay.
Yeah.
Yeah.
And there are nuances, logistical things that they need to do a little differently. Like,
right.
And again, I'm because I'm not Canadian, I haven't gone through it myself, but like in the US, we have the SEC, and you talked about the Howey Act, and what's the security. And so in Canada, and I know a little bit about it because I have students there, they have different provinces. So there's an Ontario Securities Division, there's a British Columbia Securities Division. I don't want to demonstrate my ignorance and not know all the Canadian provinces. And so you'll need to, the Canadians out there that are raising capital, they'll need to get familiarized with those and have their, local syndication attorneys involved in their equity raises.
Yep, absolutely, 100%. Well, Brad, I know we're getting to the top of the hour here, and I just wanted to thank you so much for making yourself available. Of course, I'm going to see you here in a couple of weeks up in Toronto as we're together with other great educators and other great speakers. Everybody that is a listener, if you like this episode, I'd like you to do 2 things. Number 1, give us a thumbs up, give it a like. But number 2, become an active subscriber so that you can continue to listen to the Capital Catalyst Show, learn how myself, Brad, and many of the other guests that we've interviewed that you've listened to along the way are changing their lives, transforming the lives of others. Brad Sumrok, thank you so much once again for being a wonderful guest on our show. And this is Brad Blazar to all of our community saying, we'll see you next time.
You've been listening to the Capital Catalyst Show with Brad Blazar, the best place for entrepreneurs interested in doing something big in life, having considerably less stress, and a more balanced life. Go to bradblazar.com for more ways to accelerate your success.